it did come to pass in the next 4 weeks as we moved into the COVID world. And so look forward to hearing, Sharon, your current views on the world, and we'll pass over to you.
Thanks, Jack. Yeah, so some of this, some aspects of this shock have turned out as I predicted, and some certainly haven't. If you're not, actually, could you all just please mute yourselves? I should probably be able to do that to you, but I don't know how. So I'll just ask you all to do that yourselves. Thank you. Right, I do have some slides. We'll see if we can make this work. It's always good to have pictures. There we go. You might need to rearrange a few things on your screen so you can see them. But yes, Fortress New Zealand, we've sort of turned into either the Hotel California or the Willy Wonka chocolate factory, I'm not sure, but not many people coming in or going out. And right at the moment, not a lot of goods coming in either, which is another aspect to this whole fortress thing, which is going to cause a few headaches in the economy as we go forward. But I think it's fair to say that things on the whole have gone a lot better than they might have for New Zealand. And certainly back in February, I would never have guessed that equities would now be higher than they were then, and that the housing market would be on an absolute tear. I obviously have concerns about the sustainability of all that, given the deteriorating fundamentals, but hey, that's a problem for another day. Let's celebrate our wins. So of course, our most important win is that we have managed to maintain a much lower level of restrictions on our economy than most anybody else. Here's a few countries that have selectively chosen, I admit, but basically you can see that many other countries have had to increase the restrictions in their economy as they've, particularly in the Northern Hemisphere, dealing with a second wave or third wave in some cases, particularly in the winter, whereas New Zealand, we did have that smaller lockdown light in August, but apart from Auckland hospitality, the impacts on the economy were incredibly limited. In fact, we saw business sentiment improving throughout that entire episode, which really surprised me. I thought that that would really have rattled people. The confirmation of the fact that elimination wasn't actually a one-shot game, it's a process, even though we'd been told that from the get-go. But the good news is we are getting better at this, and unlike many other countries, and so the worst case scenario is probably a rerun of August, not a rerun of March and April. So our firms are enjoying a degree of certainty about the future that many other countries just can't. And so although our GDP fell more in Q2 than most, because you can see our lockdown was harder than most, and with the benefit of hindsight, probably unnecessarily so, we did reap the rewards of that. And now I think a level 4 lockdown is very unlikely as long as our contact tracing is on the case. So that's all super encouraging. So we've had numerous incursions of COVID. I've lost count, actually. It is, as they say, a very tricky virus. It does keep escaping quarantine, but it's really encouraging to see the people complying with the likes of masks on public transport, things like that, because complacency is, of course, the risk, particularly now that we've had really good news on the vaccine front, and so people will be starting to think it's all over, potentially. Of course, the UK started vaccinating people yesterday, and that's wonderful news, but there is still a long way to go in terms of it's going to take forever to get everybody vaccinated, and some pretty key things are unknown. For example, it certainly seems to stop you getting symptomatic cases of COVID, but is it possible you could still infect people? Hopefully not. That's actually, I mean, probably not, but that's one big factor, for example, that will really impact how quickly herd immunity can be reached, along with how willing people are to have the jab. Apparently the Queen's going to have it. Hopefully that'll help. So our strengths and weaknesses in dealing with this, well, yeah, good chance of elimination. We've done it, and we've done it repeatedly. We've got a massive moat. That means we can actually be pretty sure people aren't sneaking in over the border. So that's been a huge benefit. The tyranny of distance has become an asset. Global food prices holding up, obviously with exports of services decapitated. It's really important that our commodity prices and our food exports hold up. They have been holding up remarkably well. That's not really for good reasons in terms of humanity's well-being, and some poorer countries are just facing enormous food security issues this year, with the whole global food supply chain under strain. And so for New Zealand, prices are holding up, but there are real question marks around whether we're going to be able to get our fruit, for example, packed into a container onto a boat and unloaded at the other end. Things we've always taken for granted pretty much. There are serious question marks over some of that stuff this year, and that's hanging over us as a risk. But the prices are holding up at least. Fiscal debt starting point very low, even the end point in an international comparison is pretty low as well. So we've seen, interestingly, a few downgrades of in the New South Wales, for example, and was it one other state? Was it Victoria? Downgraded in Australia. I think New York was downgraded as well. So it's sort of starting at the state and local government level. But of course, we all know the pressure Auckland Council's under, for example. So yeah, that is starting to become a bit of an issue beyond just central government. But certainly, we'll get a half-year fiscal update. But the forecast was for debt to peak at about below 55% of GDP, which is lower than many started. And of course, with the surprisingly strong rebound in the economy this year, they've been bringing in more in tax and paying out less in the likes of unemployment benefits than they expected. So things are looking better on that front, which is great. And low corporate debt. SMEs sail close to the wind, always and everywhere, but corporate debt has been pretty low. So our draw yields are at record lows. It's obviously a massive distortion of the market caused by central banks' liquidity and backstopping of that market, and it will end badly sometime, in an unpredictable fashion. But in New Zealand, we haven't had anything like that sort of behaviour. In fact, if anything, we'd maybe be in a better position if corporates had borrowed and invested a bit more over the last 10 years. But we do tend to just import labour whenever it looks like real wages might be risking increasing. But of course that model broke this year, and we did bring in a few Ukrainian and Russian fishermen. It didn't go so well, and we will be bringing in some Pacific fruit pickers, but there are very clear limits on what we can do in that space. But firms aren't generally in the mood to invest, though investment intentions have bounced back a lot. So I think corporate debt's probably going to stay pretty low. We all rushed to extend overdraft limits and provide working capital. And then, of course, the wage subsidy was incredibly fast and generous, no questions asked. And actually, with most of New Zealand's business sector is now flush with cash. The exception is, of course, the tourism sector, which is now bleeding cash. And that is, of course, our key weakness, our dependence on tourism. So we estimate that the closed border knocks out about 5% of GDP. And that's going to hurt. So if you're the Reserve Bank and you want everything to run at 100%, you need to run the other 95% of the economy hot. So I think the New Zealand economy is experiencing all kinds of stresses and strains as we burn the top of the cake and have a massive housing bubble while the inside is raw because the tourism is dead. It's a very uneven economy, and while the aggregate numbers are good, there's under the surface there's a lot of variability in what firms are experiencing, and individuals as well. And unfortunately, it is clobbering the lowest income earners the hardest. I mean, that always happens in recessions, but this one's a doozy because it's hitting the services industries the hardest. So retail, tourism, hospitality, all sectors that pay badly, have low job security, but also who tend to employ casual workers and backpackers and whatnot as well. So we haven't seen the unemployment rate rise much at all, really, in response to the end of the wage subsidy. We've seen job ads and employment intentions in our survey bounce back quite quickly, yet the queues at food banks are down the street. So it is very much a us and them economy at the moment. And that's income inequality, but also, of course, wealth equality with what's happening with the housing market as well. So our dependence on immigration, that is being exposed now as a vulnerability, particularly migrant workflows at the moment for agriculture, but just generally getting skilled staff at the moment, or even unskilled staff, is more challenging. So we've seen the labour market tighten up quite quickly, which is, of course, good, but it partly just reflects a huge mismatch in skills. So basically, you've got sort of tourism and retail and hospitality shedding staff, and construction and agriculture wanting to hire, and those people aren't necessarily in the right place with the right skills. And so you always see the unemployment rate goes up the elevator and down the stairs, and that will be the case this time as well. But perhaps because of the idiosyncratic nature and the unevenness of how the shock has affected the economy as a whole, it could be a slower decline than normal. But the good news is we're now picking a peak of unemployment of around 7.5 rather than double digit. So that's definitely a win, particularly in light of high household debt, another weakness. So that was at record highs before this, and it was about at 2007 levels. It's now going ballistic, of course, with banks experiencing record levels of mortgage lending in October and November. Indeed, we've had settlements fail because banks can't get the paperwork done fast enough. ANZ's doing well. If you need a mortgage, we've got great systems, but anecdotally, some of our competitors are struggling to get the paperwork done. And that's just simply because of the scale of what's going on at the moment in the housing market. It's gone completely nuts. So, of course, household incomes are under pressure, albeit very unevenly, yet households are feeling much more comfortable about taking on debt. So that's a sort of dynamic that can end badly. Leave it there. And of course, the New Zealand dollar is proving remarkably resilient, and we've been revising our forecast up. We've now got it going to 74 cents next year. So that's unfortunate insofar as typically in the global recession, our exchange rate falls through the floor and provides a really useful loosening of monetary conditions and lays the groundwork for an export recovery that leads the economy out of recession. That's just one of the things that's been very different this time. But insofar as it reflects that our commodity prices have been very resilient as well, and we've had more success against COVID than just about anyone else in the world, we are a good news story, and our currency is reflecting that. So I think we might just have to live with it. Put it another way, if the exchange rate goes to 45 cents, something has gone horribly wrong. So be careful what you wish for as an exporter, I would suggest. And yes, our dependence on China, it's a strength and a weakness. It's underpinned the massive rise in our terms of trade in the last 12 years. But look at what's happening with Australia and China, and you can see, yes, China is concerned about food security and keen to shore up food supply, but we are tiny. We can't even feed one Chinese city. You know, China is not going to starve if they stop exporting food from us. Or put another way, if they are starving, we can't save them. There's just too many of them. So it is true that our products are beloved by the upper classes, but I suspect Australia red wine would fall into that category as well. And as long as the US-China relationship keeps deteriorating, it's going to be pretty challenging for New Zealand to keep our head down and stay out of it and avoid taking positions offensive to someone or another on various issues. So least affected in the economy, well, supermarkets have had a great year. Online retail has as well. We've seen a turbocharging of the existing trend there. Agriculture and forestry, some disruptions and labour issues and whatnot, but generally speaking, doing fine. And related to that, food manufacturing. Construction, they were very, very concerned about the outlook, which made good sense, but basically the housing boom plus the spillovers into the lower end of the commercial property market have saved them. There is still definitely concern about the pipeline, particularly for commercial construction. But at the moment, you know, the government's plans to build lots of infrastructure is looking like it might run into quite serious capacity constraints in the construction sector. The skills between infrastructure, residential and commercial aren't as interchangeable as you might assume. That's one factor, but also just generally things are holding up reasonably well, but the lags for infrastructure are long, and absolutely anything could happen from here. So it may end up still being well timed. We'll see. But I think the real danger period is not the bottom of growth, not at all, because government's fiscal and monetary policy are throwing the kitchen sink at it. The risk is actually when you come out the other side, and the euphoria, which I think New Zealand's already demonstrating as having come out of COVID before everybody else, that euphoria, that extra demand for goods, because I mean, travel capacity is going to come back only very slowly. Mothballed planes take forever. New Zealand may never be as well serviced by airlines ever again as it was before COVID. So high demand meets still constrained supply for a bunch of goods and services. You get a flurry of inflation pressure. That might mean that central banks have to suddenly reassess their promises to keep interest rates low forever. And at that point, a bunch of asset prices that are priced assuming interest rates will be low forever, it might have to yeah, might have to rethink things. And so taper tantrum, if you will. And of course, unconventional monetary stimulus is more difficult to exit than traditional stimulus. You're not just reversing OCR cuts, and just look what happened when the US Federal Reserve tried to just change the second derivative of their bond purchases in 2013. It's very, very difficult if you have massively intervened and distorted financial markets. It's very difficult to extricate yourself. The US junk bond market would be an absolute case in point. But just equities generally, I do believe there is an assumption that central banks everywhere and always have got your back as an investment, as an equity investor. And at some point that's going to be wrong. And that point's going to be when we get a decent burst of inflation pressure. It's not in our forecasts, but over a long enough horizon, it's absolutely a certainty. Take 1,000 years if you like. It's absolutely certainty there will be inflation, either because demand is strong and supply is struggling, or because you get a negative supply shock like a war or something like that. Something at some point will cause inflation. And at that point, central banks are going to have to reveal their hand. Are they actually serious inflation targeters, or are they now actually fiscal policy enablers? The two things look the same at the moment, but if you get a decent burst of inflation, they don't. And so then you can imagine a scenario where yield curves steepen either because central banks are expected to raise rates to head off inflation, or because they're not expected to raise rates to head off inflation, in which case inflation risk will cause the yield curves to steepen. Either way, central banks have lost control of the yield curve. They can anchor the short end, but they've lost control of those longer rates. And at that point, the game changes. So, but I can't forecast that sort of thing. It could be 10 years off, could be more, could be next year. I don't know. But I would just say the low point of the economy is not the most vulnerable point for asset prices. Though, of course, we did have quite a lot of drama in March and April. But yeah, that was a pretty spectacular recovery. Never underestimate the power of central banks, I think. Until they run out of bullets. That's inflation that will do that. Least affected, obviously, the housing market. That took everybody by surprise. You know, we got it wrong. Everybody got it wrong. Matters most that the Reserve Bank got it wrong, of course, because they suspended the LVRs. I don't think they would change what they've done with the OCR if they'd known what was going to happen to housing. Indeed, this is how monetary policy is supposed to work. But I do think they would have left the LVR restrictions in place. They're of course, now consulting on putting them back in, but it's become a bit of a non-event because banks have already put the restrictions back on. BNZ, I think, was the last to do it, but given everyone is really, really struggling to keep up with the demand, no one bank's going to be left behind taking all the higher risk mortgage lending, investor lending. So, so those restrictions are effectively already back on. I think that the 30% change is still within the realm of where many property investors can just shuffle things around, and it won't be quite as tax advantageous as it was, but it's still a winning proposition to buy and invest a property. Whereas you start going to 40% and you're actually starting to seriously constrain people's ability to leverage up as much as they want to. So I wouldn't necessarily assume that the restrictions are going to come back on at the level they were before. If the housing market keeps going strong for the next couple of months, then I think those LVR restrictions may well come in at a tougher level for investors. Of course, the fact that they're coming back is causing, could potentially cause a bit of a flurry of demand from investors, but given banks have pre-positioned themselves for that already, I'm not, I think it's a bit of a non-event there. Yeah, so worst affected, well, I need to take commercial property out of that queue, out of that one as well. I had housing in there originally, and then it moved to the middle, and then it moved left. Commercial property is going the same way. Insofar as people are looking for something to do with their money, just they take it out of the bank and do something with it, which is exactly the words Adrian Orr said. He told people to go and take some more risk. But of course, the trade-offs between monetary policy and financial policy, financial stability policy, have never been so stark. The Reserve Bank tries to dance around it and deny the conflict, but the conflict is real. So it leads to quite farcical situations where the government is saying banks need to be courageous, and then literally 20 seconds later saying banks need to pull their heads in on higher risk lending, and if they don't do it themselves, we'll do it to them. So you want us to be courageous, but you want us to pull our heads in. And mortgage lending is the only game in town because businesses are still holding off on their investment and expansion plans until the economic picture is clearer. That always happens at the beginning of business cycles. So which is it? You know, you've got to pick. Of course, we had the chief economist there saying putting the LVR restrictions back on would be unhelpful. And from a monetary policy point of view, which he sits in the Economics department, it absolutely would be. But if you're Jeff Baskin sitting in the Financial Stability department, then it would be very, very helpful to put them back on. So, of course, in some countries like Australia, the monetary policy and the financial stability policy are different organisations. But here we've got one guy with two hats, and it's very hard to wear those two hats at the same time at the moment. Hospitality, you can see in our card spending data, for example, it's almost back to par, but basically the lost spending there has never been recovered. Whereas the likes of durables, we've seen not only the catch-up spending, but also substitution, people buying spas and new kitchens instead of their overseas holiday this year. So that is a one-off though. It's not going to keep contributing to growth in durable spending, but certainly it's been happy times for people selling e-bikes or spas or building materials, except they're really, really struggling to restock. There are, I think, 9 ships queued up outside Auckland Port, looks like Singapore. And that's a bit of a perfect storm of labour issues and automation issues and issues at Sydney Port and COVID and lack of containers and you name it. But the implications are that basically you will have much better Christmas presents if you hold off till the end of February. There'll be amazing sales this year because all the Christmas stock is going to arrive in January. So it's, I think, the retail, it's obviously an issue for the retailers, but once you start getting to things like building materials or agricultural chemicals or something, then it gets a bit more serious. So we've actually added a question on freight disruptions to our Business Outlook survey this month. So it'll be really interesting to see, just asking firms to rate from 1 to 10 the impact on their business of difficulty getting stock in and goods to their customers. It'll just be a snapshot, obviously, but we'll keep it in there so we can get an idea of how that's evolving, because I think that is an underappreciated risk to the outlook. But there's no question this is the weirdest recession ever, and we haven't really had the recession yet in terms of a recession being people's individual economic choices impacting other people's economic opportunities. All we've had so far is the disruption from the government's health response. And yet the country is experiencing a big negative income shock. I mean, there was a whopping income shock from the lockdowns, but the government stepped in and filled that hole with a huge fiscal stimulus, just morphine. So while GDP fell 12.2%, incomes barely budged. But going forward, of course, the income shock from the closed border, that's still coming. So I find it useful to think about it as a more an accounting sort of sense. If you're a tourism business, you're sitting there and you had a good summer and then the wage subsidy arrived, no questions asked, and then in winter we typically export more Kiwis to warm beaches than we import skiers, so actually there were more tourists around than usual because the border was closed. But come summer it flips around the other way and viciously, so both in terms of the number of people but also from the fact that foreigners who come here are richer than New Zealanders and they spend a lot more. So you can see there the different, our estimates of the different levels of activity possible under the different levels of lockdown. So level 4, only about 2/3 of economic activity was even possible. So, and level 3, I think actually that estimate now is too conservative. It's probably up closer to 90% because in the second level 3 lockdown, if you look at the movement data, the big difference was in movements of people around retail. So basically a lot of retails had their click and collect sorted for that second level 3. So that it appears from the Q3 indicators that are coming in that the level 3 lockdown made a smaller dent in activity than we might have thought. But certainly the hit from that first lockdown was impressive, but the bounce back's been equally impressive. So nothing like enforced saving and then the lockdown opens and people look at their bank account and go, oh, what can I spend that on? And they rushed out and bought stuff. So here's the Business Outlook survey. You can see many indicators are back where they were over last year, and actually the preliminary November data that isn't in here actually was even higher again, with really strong bounces in the second half of November in own activity and in business confidence as well. What's really funny is that, although we don't publish this chart too much, but basically the political bias in the survey is real, and it's expressed, for example, in the difference between how firms say the economy is going to go, which is basically what the question about business confidence is, how are business conditions going to be, and how's your business going to fare, which is the own activity. Basically, they move together when Nationals in power, and then Labour comes in and a massive gap opens up, and they still move together, and then boom, so you get this big level shift in the business confidence, which was, of course, a big debate. You can sort of see it there. It wasn't just the business confidence, but it's most marked in that series, and that's why it's useless as an economic indicator. It's not even in this chart. But basically what we've seen since COVID hit is that gap closing. And I think it reflects basically the same thing as the question that survey before the election, where for the first time when asked who do you trust most to run the economy, Labour came out on top. And I think it's basically reflects the fact that managing COVID and managing economic prospects are one and the same thing at the moment. Obviously it'll get more nuanced once we've got a vaccine, but right now that's what it's all about. And Labour's got a track record in Nationals and unknown quantity in that regard. So I think that goes a long way to explaining the reconciliation between Labour and businesses in our survey. It's quite funny. But anyway, I think it's useful to think about COVID as causing three distinct shocks. And the Reserve Bank's always going on about the fact that we're not out of the woods, and we totally agree. I think, in fact, that we're probably approaching peak data surprise index. Or put another way, the peak of feeling that we are just too clever for words and we've dodged this bullet completely. We can't have. And so we are expecting a stagnation in growth next year. We may even get a couple of quarters of negative growth in a row, and which is a double dip recession effectively, well, officially. But I would say in reality that would be the real recession. But there was the lockdowns. Hopefully we're done with those. So that's huge disruption, massive volatility in the data, and the echoes of that are going to be felt for a long time. I mean, we find ourselves making ridiculous forecasts like, oh, we think building consents will have gone up 30% in a month or a quarter or whatever, just crazy numbers. So I don't envy Miles from our team who has to come up with a GDP forecast. The closed border, which is just starting to really be felt now. I mean, obviously some individual education providers have gone under and that sort of thing. And you know, the tourist shops on Queen Street have closed, but in an aggregate sense, those firms are hanging in there hoping for a travel bubble, which I don't know if they'll get or not. It's really difficult to try and balance off a certain but relatively small benefit with a tiny risk of a catastrophe. I don't know how you weigh that up. And the slowdown in our trading partners. So ironically, that's the least of our worries so far, given our commodity prices are holding up. But it's just worth remembering that typically it's a global slowdown plus a drought is what sends New Zealand into recession. Plus, just generally that business cycle getting a bit elderly and people getting a bit risk-schmisk about everything, and forgetting that debt has to be paid back. And I'd say we've gone into that now. And that, of course, causes a hangover down the track. But it's very unusual to be having that whole euphoria thing in the middle of the recession as opposed to in the years preceding it. But it is certainly true that, you know, debt, whether it's private debt encouraged by monetary policy cutting interest rates or public debt from a fiscal boom, it does have to be paid back. It does bring forward consumption from the future, and that future tends to arrive in a fairly lumpy fashion. But for now, I think it's amazing that firms' biggest reported problems are exactly the same problems as before COVID, which is just amazing when you think about it. They're struggling to find staff. They hate the bloody government. That's regulation / paperwork, and that's always up there, particularly for farmers, of course, but generally across the board, and competition. So of those three, only competition could really be considered a not busy enough problem. You can see their low turnover jump. This is from September though, so we'll get the December read, and anecdotally now firms are having much more trouble keeping up with demand than they are low turnover on average. So it'll be interesting to see what happens to that one. But the big three haven't changed at all, which is really quite amazing. Job ads, you can see, yeah, the markets get very excited about 30% rises and 40% rises or whatever, but there's a lot of data looks a bit like this, where you've had a ridiculous V and big jumps, but not quite back where they were. And indeed, you know, the job ads are actually in a declining trend if you're brave enough to try and put a trend through that kind of volatility. So we are seeing at the same time a rising unemployment rate and increased difficulty finding labour. So that's just really awkward. for everyone, unfortunately. And of course, you throw an increase in the minimum wage in there as well. And unfortunately, you're not giving firms every possible incentive to hire people back as fast as possible. So the wage subsidy scheme was very effective, no question. It was probably over-generous in hindsight, but it was never going to be correctly calibrated in the heat of war. It will save some jobs. In some cases, it will have just deferred redundancies, and we'll find out in the first 3 months of next year, I suggest. There's some economists out there saying, look, the wage subsidy finished a few months ago and we're fine, so therefore that's not going to matter. I don't think that's quite right. I think you've got to think about it in terms of cash buffers and when they run out. And I think that's still a test to come. So oddly, households are saying it's not a very good time to buy a major household item. And as you can see, that's got a really strong historical correlation with actual spending. So that's the best indicator out of our consumer confidence survey rather than consumer confidence itself. But as you can see from the real retail sales data, they have been spending on major items. So I think that reflects both a degree of catch-up, but also the substitution I'm talking about from holidays to stuff, particularly nice stuff for your house. And yet what's interesting is that households are saying it's about as good a time as 2009 when we were coming out of recession, or else the 2010 double dip recession, which we didn't know about at the time. But so those were not happy times for retailers, as you can see. And yet you ask households, is it a good time to buy a house? And they were saying it's the best time since 2012. Now that did dip a little bit in the subsequent survey, but it's still right up there. And that, of course, reflects the power of low interest rates. So it probably doesn't mean people are buying houses but not buying furniture. But could be. I think it partly reflects the K-shaped recovery that 90% of the economy is relatively unscathed and thinks it's a great time to borrow $500,000. But 10% of the economy has been wiped out and doesn't think it's a good time to borrow $500 to get a fridge. So it's a very weird time. So it's useful to think about GDP in level, in fact, everything in level terms, because the changes are just ridiculous, but to some extent. But you can see there we have a big fall in Q2. Q3, it's the numbers looking stronger than that now, actually. So we could potentially even see a complete V, which would be quite something. But that wouldn't change. That would just be a timing shock. It would, if we get a really stonking Q3 GDP, like plus 15 or something, that would increase the odds that Q4 is negative. So, and then Q1 may well be negative as well, because that's going to be crunch tourism income hit. But the point is there, you can see the stagnation. That's, in a way, the actual recession. You can see it's very much in line with previous recessions that we've had. That disruption from the lockdown was the one for the record books, but the actual recession hasn't happened. Whether it is actually an official recession in terms of 2 quarters of negative growth, I don't know, but it's basically a stagnation. And so we've built a bit of reality into house prices there, and you can see at the bottom, but house prices and reality are not always closely correlated. Certainly at the moment they're not. But I would just say that if house prices keep booming, then they're going to bust at some point. The more they go up from here, the greater the odds that they will actually fall at some point. But the top right there, you can see the unemployment rate forecast. We've still got it going over 7, but a lot lower than it was. Our forecast is actually higher than the Reserve Bank now. But I guess in there, we've just got a bit of a sense check that typically our recessions are a result of droughts and commodity price shocks, so that are focused, at least initially, in the agriculture sector. At this time, they're focused on the people-centric industries. The retail, hospitality and tourism, they all punch above their weight in terms of employment share versus GDP share. So just in that sense, in that context, it makes sense the unemployment rate should rise higher than in the last recession, all else equal. Of course, all else is never equal. And there's plenty of uncertainty around that. But effectively, we don't have the unemployment rate dropping until the border opens and tourists start coming back. Though, as I said, that's not going to be a light switch moment. Those mothballed planes apparently take months to get going again. And the New Zealand route was a pretty hard one to make money on already. And Air New Zealand will not be the only airline reimagining its future as a much smaller airline. So I just don't know if we'll ever get the capacity back that we had, at least not quickly. So you can see here mortgage rates have dropped steadily, and at the bottom there you can see the very, very strong bounce in lending. It's been pretty ballistic actually, and in particular, well, you can see that some of it's lockdown catch up, but some of it goes beyond that. And that investor share between 70 and 80%, which was made available for the first time in years, that light blue cyan colour, you can see that was part of the story, but the other owner occupiers and the first home buyers are definitely a big part of the story as well. So it's not just investors, not at all. And it's not all just cashed up Kiwis coming home either. I mean, certainly in places they'll be having an impact, like where I live in Devonport, for example. I suspect that has had an impact, but other, in aggregate nationwide sense, immigration's running at a fraction of what it was. There's the chart I put in Charts That Matter last week. I found it quite funny. So New Zealand Google searches for how much can I borrow versus the inverted 1 year mortgage rate, which is where banks have been competing hardest in the last little while. You can see there. So basically it's absolutely a portfolio financial shock that's going on in housing at the moment. And yes, we have a non-responsive supply sector, and we've got X number of houses short and all that sort of thing. But basically, we're not wildly short, any more short of housing than we were a year ago. We should be less short of housing in a way, because we've been building like the clappers, and immigration has plummeted, and rents are not increasing rapidly at all. So there's not a worsening shortage of housing anyway. And particularly since Airbnbs are now available as long-term rentals, so that's actually increased the supply of rentals. I think this is just simply people working out that they can borrow a lot, and they can therefore buy a better house, and they're competing vigorously with each other, and off you go. So it's, yeah, and the Reserve Bank can certainly point at the structural factors that underpin our housing market, but there's no question that's what has happened this year is the result of 75 points of OCR cuts and quantitative easing and funding for lending program impacting people's behaviour. So banks don't need more funding. You can see there that light blue line on the top. So essentially, the quantitative easing involved printing a lot of money, which the government then used to buy bonds, which the government used the proceeds from that to pay out the wage subsidy. So all that money landed in bank accounts with a smack. You can see, poof. And so the bank's funding gaps, which were actually a big problem, we were having to start constraining lending, that's now closed pretty much. So the funding for lending program is not actually addressing a funding shortfall. It's just trying to fund banks cheaper, or at least allowing banks to know that there is a backstop of cheap available funding, so that banks feel more comfortable cutting their term deposit rates, so that then opens up headroom for them to cut their lending rates. So that's how it's supposed to work. It's a pricing tool, not a quantity tool, and the Reserve Bank will not measure its success in terms of how much money gets taken up, particularly at the beginning with, banks have got plenty of funding. So it's not going to be a rapid fire impact here. It's just going to sort of eat away at what's underlying mortgage rates and provide room for them to go lower. But it's probably fair to say that banks wouldn't be sure right at the moment whether cutting mortgage rates would be considered a social good or a social evil. What are you supposed to do as a bank? You get pilloried if you don't pass it through, but at the same time, there's a widespread recognition that the housing market is causing all sorts of problems in terms of income and wealth inequality, housing affordability, and potential financial stability risks. So I'm not sure that banks will be feeling 100% under pressure to pass through everything as fast as they possibly can right at the moment. It's a weird situation. But certainly the Reserve Bank is assuming that they will, and has basically, if you read between the lines, said to banks, cut your mortgage rates, or we're going to cut the OCR more, and it may well go negative. That's kind of the deal. But at the bottom, you can see there how much business lending has dropped. It's running -3 or whatever. And that's exactly the same as happened in the last recession. It makes perfect sense that investment projects just go on hold until things look a little clearer. But you can see there the household lending holding up, and most of that is mortgage growth. But you can also see that this credit cycle has been much, much more subdued than the last one, which went a bit nuts, particularly dairy lending. You can see there that was a white gold rush there. and we're still cleaning up the mess from that. Dairy lending is it's been knocked out of the headlines by the housing market, but it's been hard work to try and get that real debt down when it's been so ingrained in the agriculture sector that you never pay back principal. You just service your debt forever and land prices take care of the rest. Well, yeah, that hasn't been the case for a while. And at the moment, with land use rights still so unclear with water regulation and the like, I think that's going to stay an issue for a while. So you can see there how sales have overshot, and it's getting harder to argue now that it's just a bounce back from the lost or delayed sales. But listings are only running pretty much about where they normally are. So basically that means that there's a real shortage of houses. So housing market's hard to predict at the best of times, but I'll just say there's huge offsetting forces for housing at the moment, and the positives are fast while the headwinds are slow. So you've got record low mortgage rates. It's obviously working. You can see that in that Google chart. Lower net migration is reducing housing demand, all else equal, and the loss of tourists and the foreign students is freeing up a lot of housing. Unemployment rate heading towards 8%, but I mean, on current trends, we'll be revising that number back, but I don't know, we'll see. And the LVR restrictions were suspended for a while, and that caused a bit of flurry of activity. But it's been well signalled that they're coming back, and indeed banks have already reimposed them. So we do have a wobble in our forecast next year. We're not certain it'll happen. The housing market's hard to forecast at the best of times, and where there's a lot of moving parts at the moment. But our OCR forecast does depend very much on what happens to the housing market, not because of Grant Robertson's letter, though certainly that did make OCR cuts more political, but just because the Reserve Bank's models will tell them if housing's booming, then households will spend more money and the economy will be stronger. So here's our commodity prices. You can see they've been outperforming world food prices for a long time, and basically that reflects that little bottom left chart there. The share of New Zealand exports going to China has been not quite a one-way bet actually. That dairy cycle that you can see there in the middle, that was pretty painful. That 2015 was not a happy year for dairy. So, but essentially our overall exposure to China has been steadily increasing, and our terms of trade have been steadily increasing along with it. But just this year, it's the global foods supply disruptions have been supporting our food prices as well. We've actually been revising up our milk price payout, and Fonterra has as well, which is quite a remarkable thing considering the whole in global growth. So some of that reflects that we're not the only economy to have thrown the kitchen sink at supporting growth in terms of fiscal and monetary policy, and it has been successful, though at what long-term cost we'll see. But so exports of goods are doing fine as long as they can get containers, but exports of services are obviously reeling. So tourism's 13.6% of the economy, or was. Domestic tourism nearly 8% of that, which is twice the size of international tourism nearly. And then your students are worth another 1.5. So when you work out the hit to the economy, you've got to recognise that GDP is being boosted by the fact that we can't go and have our holidays overseas. That's an import of services. And but there are indirect impacts on hospitality and retail as well. So we've come up with a number of about 5%, and that seems to be pretty much consensus. But tourism is a bigger share of employment than it is of GDP. But a big employer of backpackers and the likes as well. So some people will have lost their jobs and left the country and never show up in our unemployment statistics. But like in Australia, where New Zealanders can't access benefits over there. So that's the problem with this immigration of New Zealanders that we are seeing. Are they like gazillionaire New Yorkers coming home for a couple of years so their kids can go to school? Or are they unemployed baristas from Melbourne moving back in with their parents? So, very, very different consequences for the economy. And the short answer is we have no idea, unfortunately. We just don't have that data. So there's what I talked about, the seasonality of tourism. So during the winter, closing the border was a win for GDP. Like in Australia, basically, they actually run a imports and services deficit. So on average, closing their border to tourists in and out was a win. That's not the case here. You can see that from now onwards, basically, there's a lot of lost income. And so there'll be a lot of firms bleeding cash, hanging on, hoping a travel bubble is announced. But I don't know. One COVID-infected tourist going up and down the country could send us back into level 4 even, or at least level 3. So I don't know, is it worth it? When, to be brutally honest, a lot of these little businesses, they'll pop up again quite quickly when the time is right, in terms of hospitality joints and whatnot. I don't know. But one thing's for sure, we can't just keep issuing the wage subsidy. It's just too expensive. So there's the net migration. I don't entirely believe the numbers from last year. It just doesn't make any sense, particularly when you match it up with the light traffic and the truckometer index. I think the reason that light traffic predicts the economy 6 months ahead so well is that it reflects population growth. And it just smoothed right through that crazy spike. Well, I mean, it flattened off, but that crazy spike last year just doesn't look right to me. And the data is prone to massive revisions ever since we got rid of departure cards. So who knows? But I do believe the numbers now, because basically the issue with the new data is trying to sort the wheat from the chaff, trying to figure out who's here for a long time versus who's here for a good time. Well, hardly anyone's arriving now. So basically that problem's gone away. But so I do believe migration is now very weak, and that is a big change for the New Zealand economy. And immigration has created half of our economic growth in the last 5 years, for good or ill, and it certainly is a mixed bag. Great for the construction sector, not so great for health, education, roading, all this infrastructure which has simply not kept up. And so certainly this infrastructure spend up there, planning is more than just about boosting GDP. It's also about, deferred maintenance, if you like, in terms of just building the New Zealand that we actually need for 5 million people. So government core crown debt, as you can see, up to 55, but I expect the half-year update to show a lower number. But still, that ramp up in debt was a lot of bonds to sell really fast. And if you have to sell a lot of stuff really fast, you probably have to cut the price. And the inverse of a bond price is its yield. So essentially, for the government to borrow a whole lot more fast, you would expect that to put a lot of upward pressure on bond yields. But the Reserve Bank stepped in and bought it all pretty much one for one. So that solved that problem. The cap on QE is 100 billion, which is a third the size of the economy, which I read one thing that said that's how much we spent on World War I. So a big number, but I don't think we're going to get there, particularly now that the government books are looking much better. And so they're likely, if anything, to be revising the bond issuance program down. And the Reserve Bank has a limit, not only in terms of how many billions they want to spend, but also the proportion of the bond market that they're comfortable holding without sort of destroying the liquidity in that market. I mean, no one wants to turn into Japan, where basically the Bank of Japan owns the government pretty much. And because a well-functioning liquid bond market really is the foundation of your financial system. But there are the deficits, put it in context, I mean, they will be being revised up, I'm sure. But essentially, you're sort of looking at a Christchurch earthquake style deficit there. So one day we are going to have a grown-up discussion about higher taxes, new taxes, changes to super, and so on. We put out a piece this week discussing how basically the boomers are shafting millennials, though we didn't use the word boomer anywhere in the document. It's a bit of a push-button word. But yeah, it's essentially the government debt from COVID, the booming house prices, climate change, all of these things are clobbering our younger generations. And at some point, they're going to get so angry that they might actually vote. And then it'll be a different world. So why have we still got OCR cuts in there, given that we've been revising our forecast up so much? Well, essentially the Reserve Bank's forecasts still imply 70 or 80 basis points more easing, and we don't think they can get that without cutting the OCR further. So the urgency has reduced, though, particularly with what's happening in the housing market. So we've got one cut down to close to zero, 0.1 or 0.05 or something in May, and then a very conditional cut in August. That's reflecting the fact that we think the economy in the first 6 months of next year is going to look nothing flash. But the hurdle for that second cut is high, should be high, because cutting into negative, I mean, yes, it's just a number, but a negative OCR, the risk is that the headlines that would generate would actually damage confidence rather than boost it. But in terms of the actual financial costs of a negative OCR, the risks to credit supply and stuff, the Reserve Bank's thought quite hard about those. And that funding for lending program was originally envisaged as an adjunct to a negative OCR in order to reduce the unintended negative side effects on bank profitability and therefore banks' willingness to lend money. But yeah, very, very low interest rates are hard to get out of because they're a little bit self-fulfilling, because they encourage people to take on so much debt that any interest rate increase would be a huge brake on the economy. So whether you're talking about extreme conventional monetary policy or unconventional monetary policy, we're getting into places that are really hard to get out of in a smooth fashion. So there you can see our exchange rate. It's bounced despite OCR cuts, and that's because we're good news story. Firms are saying actually that their costs are rebounding, that their pricing intentions are almost back to where they were. So, but their inflation expectations are still pretty low. As long as their pricing intentions are bounced back up, then you could argue the Reserve Bank shouldn't stress about it, but they will, I think. So this is another factor that's underpinning our calls that on balance they are still more likely to cut the OCR again than not, because basically inflation expectations are becoming anchored around, well, under 1.5 rather than at the target of 2. At this point you sort of go, well, who cares? Is it really worth causing a massive housing bubble over this? But that's their mandate, so that's what they've got to do. So there you can see the global equities. They left the pre-COVID peak behind some time ago, a few wobbles along the way. There are plenty of earnings challenges ahead, but hey, we are firmly in the bad news is good news side of things, because it means more central bank liquidity and it means increased chance of a US fiscal deal. We've also got Brexit looking a bit like a train wreck in the next 48 hours. That's a bit hairy, the US-China relationship and how impact that might have on things, plus the whatever Trump might decide to do in the remaining time he has available. So there's plenty of risks out there, geopolitical and economic. But yeah, good news is good news, bad news is good news, no news is good news. We've seen this before. I'm sure the average age of this audience has seen this before, and so I won't go on about that. Credit spreads, this is out of date. They've gone lower still. They are now at record lows, the junk bond yields, and that's because basically the Federal Reserve is rightly or wrongly being seen as completely backstopping that market. But of course, Mnuchin said he's going to close down that program and repurpose the money, the program that's basically acting as a backstop for junk bonds. So at the moment, everyone's going, oh, whatever. But at some point, you could see a normalization or even an overshoot in risk spreads if people decide actually the central bank hasn't got our back and actually risk might matter, and actually I might need to understand what I'm buying here. What does that acronym mean anyway? Sort of things like that. I do honestly believe we're sowing the seeds of something ugly at some point, but when that point is, I have no idea. But I would just say that the risk pricing is utterly distorted, and when the pricing of anything is distorted, people will demand the wrong amount of it. So given all that uncertainty, take anyone's forecasts with a grain of salt, including ours, but there they are. Oh, there they were, gone. I'll leave it there. Now we do have a couple of questions come up here.
Yeah, Sharon, can I jump in and just fire those through? So we've had some questions. The first one's actually coming on the chat channel, and you did talk about the exchange rate quite quickly, but the question was, what's your view on the exchange rate going forward? And I'm going to give you some windows of 6 months and 12 months so you can actually answer that, and whether it's US weakness, and then is hedging the US assets worth it from here? So over to you on that one first.
Oh, hedging is always a question of what risks you can live with and what ones you can't. But we have upgraded our Kiwi US forecast. So we've now got it at 74 cents by the end of next year. Of course, on its current trend, it'll be there a lot before then. But a large part of that is a weak US dollar story. So there's much less change to our other forecasts. We've got the Kiwi Aussie sitting between 93 and 95, for example, or against the Euro about 58 through our forecasts. So that's what those are. But yeah, I think the US dollar story is a tricky one, because the US dollar does well when the US is going well, and it does well when the US is going incredibly badly, because then it becomes a safe haven. Though I can't see much safe about US government debt at over 100% of GDP right at the moment. But in that in-between bit, and that's where we are now, where things are a bit blah in the US, but risk appetite is still strong, the US dollar tends to struggle, and our forecast is for us to stay in that kind of world for a while. And for our commodity prices to do all right.
Second question was in regards to your appearance on Q&A with Rodney on the weekend.
Yes.
The comment was that it sounded like you were convinced on his inflation scenario, but said it wasn't in your forecast at the moment. To what degree are you looking at this risk, locally and globally, and what would the impacts be?
Yeah, well, I think it's worth talking about because it would be a game changer. It's not a high probability event necessarily over, say, a 12 to 24 month horizon. But over 1,000 years, as I said, it's a certainty. So pick whatever scenario you like over that wide period. But I do think that period when, you can look back over history, and there is a period of euphoria after pandemics as everyone rushes out to seize the day and enjoy their lives again. And it's not 100% clear that the supply chain it will recover as quickly as demand. And so people are assuming that inflation is just dead forever for reasons that aren't 100% clear. But why should it be, really? I mean, psychologists show that people put far too much weight on recent history when they assess the possible range of future outcomes. If I was assessing the possible range of future outcomes for inflation, I would include the 1970s, because inflation targeting was introduced by politicians in response to a voting public who was sick to death of inflation and want politicians to fix it. That's not today's voting public's primary concern. They think inflation's dead and that it's just magically gone away, and therefore we should be focusing on housing affordability, or on inequality, or on climate change, or on whatever, or just then throw in the mix the fact that governments have got an unbelievable amount of debt. So if central banks raise interest rates, then you're going to have to cut your health spending. I just don't think the voting public cares enough about inflation anymore for inflation targeting to survive in the long run. The trouble is what replaces it. I suspect the interim step is looking a little bit like the 1970s, but you can't forecast that sort of thing. Yeah, I mean, you're talking effectively, inflation expectations are an unbelievably unstable system of crowd expectations. I mean, it's a really, really unstable system. You cannot forecast it. And it might be something obvious like a war, or it could be a flap of a butterfly's wings. I don't know, but I would say I've seen more things talking about the risk of inflation in the last 6 to 12 months than I have in the last 5 or 6 years. There are a lot of people who think they'll be first out the door when inflation comes back as a result of all this extreme stimulus and money printing.
Okay,
and we can't all be.
So we're going to flick back to currency for the next question. So apparently China is currently trialling a digital currency, and reports suggest that the US has passed legislation to pave the way for the same outcome. What's your view on what impact a digital currency would have on the monetary system, and if when New Zealand might follow down the same path?
No, I'll just front up there and say that is not something I'm an expert in at all. But yeah, I think it is important, and we do need to get our heads around it, definitely. But for now, I think we could have enough fun and games with the traditional currencies to worry about at the moment, with central banks having done everything in their power to debase them, both their internal and their external value of their paper currencies. Ben Lavender's going to answer this question. Go, Ben. Well, it's just flashed up.
He's confused as to what's happening, so he's not. So we're running up on the hour now. So we'll finish with a question that I'm asking everyone that I'm talking to at the moment. And if you're looking at, say, the RBNZ as an example, they're printing, and I know we're not going to get there now, but let's say they're printing $100 billion and using that to buy government bonds. They end up owning over 50% of the bonds, and everyone's saying that $100 billion is a debt that needs to be repaid. Why can't the Reserve Bank in New Zealand simply forgive the bonds when they mature? Because it's basically rock and Peter to pay Paul. So talking modern monetary theory. So do you want to talk through why they might not be able to do that?
Well, they could, but then the debt is still sitting there, and the settlement cash balances, it hasn't actually gone away. You've actually just shuffled paper. And if you did default on your debt to the Reserve Bank, then you've actually got an insolvent central bank, which you would also need to potentially refinance at some point so it could do its job properly. But yeah, no, I don't really want to go into the plumbing of it. You need to sort of understand how the whole, it's like an accounting system with the settlement cash that the banks hold at the Reserve Bank, and the government's involved because it's got a settlement cash account as well. But yeah, I'm not sure I want to go into the depths of that. But the upshot is that you cannot make that debt magically disappear. You do swap one liability for another one. But if government keeps growing as a proportion of the economy, and you've printed a lot of money, then you absolutely are setting yourself up potentially for inflation pressures down the track. I mean, the theory is, of course, that the money supply will then come down again as the central bank either sells those bonds or enables or just allows them to roll off the balance sheet. But as the Fed and others have found, it's actually quite difficult for a central bank to shrink its balance sheet again, because then you're basically sucking liquidity out of the system, and all that liquidity has puffed up asset prices in the meantime, and blowing up asset prices is a lot more fun than deflating them again, I would suggest. So I do think that the central bank balance sheets, in terms of how much cash is in there and how much liquidity is in there, whether they're adding liquidity, subtracting liquidity, I think that's probably more pertinent for markets than what the central government decides to do with its the debt it owes effectively to itself. I think it's maybe a little bit of a red herring. I think MMT just basically fails the too good to be true test. Basically, if we could just print money and solve all the world's problems, then without any consequences, then, well, we would have done it a long time ago.
Very good. Alrighty, well, on that note, we don't have any more questions coming through, I don't think. He says, looking at Ben. So we'll finish with an observation of your Christmas tree, which is fantastic in the background, the symmetry of that wrapping.
I can turn the lights on. Hang on. Wait.
Oh, look at that. The symmetry of the wrapping, I was going to say, is fantastic, but that just really makes it now. So you'll just have to imagine a round of applause, because obviously we can't do that over Zoom. But thank you very much for your time today. Thank you very much for the information and the charts. I'll hopefully get a copy of that presentation to get out to everyone who attended. And as you can see, this has been recorded. So if you want a copy of that, you can get that as well. So thank you very much, Sharon, for your time.
Pleasure. Thanks, Jack.
Pleasure.